Welcome to TradeTheNBI.com. This is John's Report is for March the 5th. What an exciting Friday that was as we had some really deep action here. Of course, the tariff issue that was so explosive that was supposed to lead to the end of the world really hasn't, because at the end of the day, you can't get past the fundamentals of what's going on. Now, we are still in a weak period, and as I said, it was a little too early for things to begin, but that should be changing now as new fund flows come in, and we got to do something with that money. Now, we've seen a complete reset here of our DOC where we're what we would almost call oversold. We're getting into that minus 20 range here with the green, which usually causes a bounce back. And that would be normal at this particular point. We had the little quick upburst, filled back in, was absorbed, and we're still at a reasonably elevated level. We are right back at where we began the year, which was right back over here. So actually, yeah, this would be the first day at the open right there. We are literally right there. So a month of craziness, then a reaction to the whole memo and FISA situation that led to the swift decline, and bought back up in that, and then you had the little tariff. It's an interesting thing because while it goes against what the global ideal is, you do have a situation where there have been unfair trade practices, and how do you unwind that? And do you even want to? Of course, this gets into the whole concept that I've been talking about for years about the way the Fed had structured things with, well, you could call it collusion with the White House, and that you had the lower energy prices, mass flood of labor into the market, and low rates, and you could pretty much do what you wanted, and you crippled the economic power of America. Now that you've dried up a couple of those elements, you've allowed for more of a free flow of movement in that, it's going to be a rebalancing. And so there's going to be some pain in between there, and that's all relative, because now you see an engine that's getting ready to start up, and global dominance of America again economically will be an interesting factor. And it's hard to describe a market that doesn't still move higher when you look at those multiples and the potential of inflation and free market again. So it'll be interesting to see how it plays out, but overall I still think, look at that beautiful break of the ABM green, and then the return above was clearly just by itself long move, and you can see very strong from the NASDAQ standpoint, still outperforming the S&P. The euro moving back up will also support prices, moving them higher, and it's still out of the range for Europe. They just had elections in Italy. It was no surprise with that, where you had a split between the far left and the far right, and mostly based off of the immigration issues in the center that was the global power during Obama. Renzi completely marginalized because the same issues that took place in America exist identically in Italy and much of Europe at this particular point. So it's going to be interesting to see how that starts to play out. It's a little tougher because by nature Europeans are a little softer when it comes to change, so to speak. That, of course, you had the fade of that hyper reaction of everyone running to treasuries. We would expect that ebbing back down again. Though you've had the rising shakeout here, so it's going to see that turn around and start to head lower again before you get the next wave lower. And that's really going to depend on some of the numbers coming out. We expect that it's still going to continue to look pretty good. And the growth in manufacturing in that is going to take a little bit of time to work its way through, but it will have significant impact into the potential for U.S. growth. Now, whether or not some countries try to make a war out of the trade issue, I don't know that they necessarily have the capacity to do it. Ideally, the steel tariff and that would have been more appropriate for just China and the abusers, but it doesn't always work quite that way. Turning to the oil markets, we can see that it's a decent maintenance here, again below the ABM green right there from a support standpoint, so move back above it. expect this to move back towards the highs. So there's going to be no other way around it. And when it returns back that direction, it's a clear indication that there's either a stabilization or recognition of both growth and inflation coming, worth bearing in mind in both categories. And there's no other way but the market to inflate based on that. And so if you keep that in the back of your mind, you'll know that, some of these dips are just that, just temporary dips. Gold. This is an interesting one. If you have time, you can go. Zero Hedge has a great article on the manipulation by central banks of gold prices and the use of gold swaps, certificates, and creative accounting. This is the beauty of accounting. I mean, it's a great expose on fractional banking and its use in the gold markets to basically create gold that doesn't exist and or hypothecate or move it around without it actually going anywhere, but giving other countries that credit for it. So it's an interesting read for those that are interested, because it's an important dynamic, because gold should be significantly higher, and people have always wondered why it's not. Well, that gives you a pretty good idea why, because it's not actually trading hands, even though it's being accounted for like that. So let's look at the day for Friday. We had to shrink this quite a bit. We were talking, there was just a lot of activity. It's both good stuff. We had a bunch of junk going on for a little while. We ended up with some of these little soft buy signals we were talking about as it related to the steel interactions, the quick spider-like moves that come back and generate at least modest positive reactions. They'll usually get you a zone or two, and then at that point you can evaluate where things have developed, and then you're going to get your traditional buy signals that will develop from there that we can see from the GAN, where it just even moves above that 50% coming off the dip, and you had the reset here of the green that led to a nice little rally. Never really dipped very low from that particular point right there. Even when you had the brief DOC spread right here, it was still above the 15 level at that particular point. You had rising brown at that point, and then it just turned around, finished it up all the way to the peak there. And some of these, if you look at the value numbers from when we were in the 2650 range, and it wasn't until the break of the ABM that happened up here at the 2680. These are good moves intraday, no less. And then you even have from the short, new longs again. It gets a little choppy in between some of those, which depending on how you use your stops. Once I get above 50% and I break above the extra zones, depending on what I'm looking at reading wise, this is still pretty soft, because you still don't have cyan moving under red, and every time it met and rejected. So I just kept raising stops for there, and then it just left for new entries at other locations. Then we had the short right before the end of the day, which actually broke down to a lower, and this is a continuation, but again, it's getting bought up fairly quick, even in the pre-markets. And I think that we're probably still going to be looking at a little bit of softness, because this whole trade tariff thing impacts some people, but I think that at the end of the day, we're just consolidating off of what has been a pretty significant overall move. I understand people like to look at it from January, but it's not really relevant to what we've seen from a significant time period, and I think you have to pay more attention to that. I think what we're seeing is a much more active market because of lower volatility, and that is a matter of lower volumes, in the sense that the bid-ask is much smaller than it has been in some time, and that is allowing for much broader swings, because we're not seeing the depth of activity. So, that added swing just gives more opportunity. It's for passive investors who are just buying and holding on to things. Is not really much of an impact to them, so they're not really seeing much of a change in anything. But I think that that's going to draw more people into a little bit more active trade mode that hasn't existed. And so this shorting of volatility that we've seen in the past, which I always thought was a crazy trade, but certainly isn't existing right now. So we'll take what we've got right now. I would expect that we're probably going to move back up towards these pre-market highs, even if we retrace a little bit more at this particular point. We're just off of a weak spot right now. Should be hitting right around towards that 50% Fibonacci level there, and if we get a new turnaround, that should propel us back into the green area. We're about -5. We've been trading anywhere from 0 to, well, even plus a little bit, well, to as much as -10, 15. So plenty of range capability even within this pre-market, which I think will continue into the normal trading session. And we'll go from there. As always, though, continue to trade well. I'll keep putting up these charts as significant and interesting things develop. Trade well.